All right, thank you everybody for coming along to another ShareWise webinar. I'm here joined by Lucas Dow with Elevra. Now, I was just going to get you to introduce yourself, Lucas, and then maybe a little spiel about Elevra, and then I believe you had a presentation that I'm sure these folks are excited to see.
Thanks, Luke, and thanks everyone for joining. Apologies we had a couple of technical issues before we got going. Just by way of introduction, my name is Lucas Dow. I'm Managing Director and CEO of Elevra Lithium. By way of background, I joined Elevra back in February of last year. I joined as a non-executive director, and then in around July of last year, the board asked me to take on the managing director role. I'm a mining engineer by training, worked across a heap of different commodities and geographies, covered commodities such as copper, silver, lead, zinc, met coal, thermal coal, manganese, and then also had some exposure to gold, platinum, and tin as well. So strong operational background, been across a heap of different operational projects, operations, greenfield and brownfield projects. So bring a strong operating background. I think you'll find as we step through and you get to know a little bit more about the company and the team, you'll also see that we're a very strong operational team. And I think that's bearing out in terms of our performance as well. So really appreciate the opportunity to be able to engage with you. And as Luke said, we've got a few slides that we'll step you through today, just to give you a sense of the company, but also most importantly, provide an opportunity for any questions you might have as well.
Yeah, perfect. The floor is yours, Lucas, if you want to run us through that presentation.
All right. So apologies for we haven't got quite a presentation view, but look, just if I take a step back, just who's Elevra Lithium? In summary, we're North America's largest hard rock spodumene concentrate producer. So, we're a significant player. We're a producer. We've also got a really unique stable of development opportunities as well. We're an ASX listed company, so we're headquartered here in Brisbane, Australia. Importantly, we've got a secondary listing on the Nasdaq as well. We've got operations in Quebec, Canada, and then development projects both in Quebec and also in the US, in North Carolina, and then also we've got a JV with Atlantic Lithium in Ghana in Africa as well. And we've got exploration tenements in Western Australia here in Australia as well. So really occupy a unique space given that we are an existing producer of hard rock spodumene concentrate, in addition to having a really unique set of development opportunities that have really got us very well positioned in North America and being able to service that market. By way of background, Elevra came to be as the combination of Sayona Mining and Piedmont Lithium. The merger completed late August, early September. It was a merger of equals. And from there, it's really generated sort of really three key elements for us. One of those is really much around scale. So as I said, we're North America's largest hard rock spodumene concentrate producer. We've also got a really significant resource base with reserves over 106 million tonnes and resource on a measured and indicated basis of 183 million tonnes. And if you would include inferred in that, it'd be sort of north of 200 million tonnes of resource. So really significant business. Importantly, one of the key catalysts for the merger was the ability to enable growth. And in short, between Sayona and Piedmont were Sayona's a joint venture partner in North American Lithium, which is our operating asset. There was an offtake arrangement in place that, in short, was going to inhibit the ability to be able to grow the company. And so the merger's basically been able to pull that aside. And now we've really got a very exciting growth opportunity at NAL, in addition to the rest of the portfolio, which I described a little earlier. And then importantly, we're very well positioned, particularly when you look at the Trump administration, even the Canadian government's desire to be able to create that regional hub around critical minerals. And so we occupy a very unique position as it relates to being a producer and also with a really great set of well-located development opportunities. Just stepping through a couple of key metrics for FY26. So we've reported the first quarter. We produced around 200,000 tonnes of concentrate a year. Last quarter, we closed at just over 52,000 tonnes. There's also, you'll see on the screen, a number of stats in terms of where our unit costs were and so forth. I'll go through those in a little more detail. One of the key things to make note of, unless referenced otherwise, the dollar amounts referenced in the presentation are Australian dollars. And a key point to note for Elevra is we closed the quarter with $149 million Australian of cash. And importantly, there's no secured debt on the balance sheet. So we're in a very unique position to take advantage, and we're nicely leveraged to a price recovery. So just a sort of a really quick snapshot of our strategy over the next 18 months. As I said, we're an operating business with North American Lithium producing around 200,000 tonnes of concentrate. Very much focused about continuing to drive our unit costs down at NAL. We've got ourselves in a pretty decent position. We're very close to being operating cash flow break even last quarter, despite prices being somewhat subdued. So that's really encouraging, and we're continuing to focus around our operational performance and particularly mill utilisation, resource recovery, so recovery through the processing facility, and then importantly, the impact of that on unit costs. So a really significant focus for us on that aspect. As I mentioned briefly, and I'll step you through in some more detail what our project portfolio looks like. But as I said, we've really got a significant resource base with a number of brownfield and greenfield development opportunities that are really quite exciting and strategically located, which is really sort of the second key component that we're focused on. And then the third aspect, we're certainly looking to being able to integrate with downstream converters. And I just should make that very clear. People should understand and consider Elevra Lithium as a mining house. So our expertise, and as well, I'll introduce the team a little later on, we're very much a house full of mining expertise. So our expertise is upstream. So, what you can expect from Elevra is that we will be developing and operating hard rock spodumene concentrate mines. We're very keen to be able to partner and provide offtake arrangements to downstream converters, but that's not our expertise. And that'll become apparent as we talk through the projects. So we are actively engaging in considering things like offtake agreements, renegotiating those, also negotiating potential new ones as well. But ultimately, it's around making sure that we've got commercially viable contracts that support the asset, and particularly as we think about the way in which we may expand NAL and the funding opportunities that we might have as well. So just as a quick recap on the merger, which I'd mentioned briefly, it really drove three key aspects. One of those was the scale, and as I said, market cap around 750 million Aussie, listed again both on the ASX and the Nasdaq. It's also allowed us to optimize costs at the asset level, particularly at NAL, and also corporate level. And then importantly, has enabled growth opportunities as well, which I'll take you through in some more detail. Consequence of all that is we've really got three buckets of synergies, and we're targeting in the order of 15 to 20 million US of recurring savings. Some of those have just come out. Obviously, we've been able to remove the duplication of corporate overheads that existed with both Piedmont and Sayona. Under Elevra, that's obviously been slimmed down. Reduction of those sort of corporate costs, obviously. The other aspect, we've been able to pull together things at the asset level. So removal of bureaucracy where we had reporting and JV structures and so forth. And obviously the unity of the combined teams and being able to get the complementary skills from Sayona and Piedmont together under the one umbrella. And then importantly, things like logistics. So being able to club cargoes together in a way that we've been able to realise unit cost savings. So to give you an example, when we first started shipping to China, unit costs were on a freight cost basis, sort of sitting around $130 US a tonne. We've been able to get those down to around about $60 a tonne. So really significant savings. And that's been on the back of a number of these synergies driven from the merger. So more work for us to do, but we're certainly well on track to hit that sort of 15 to 20 million US of recurring savings. And importantly, as I said, enables the growth options. Just looking at the board. So the board's described on the left-hand side, management teams on the right. So the board's made up of 4 directors from the Piedmont side and 4 from the Sayona side. Dawn Hickton's our chair. Dawn's come across from the Piedmont side, very experienced business person, has run significant companies before, and we've really got what I'd call a very helpful level of expertise and diversity amongst the board in terms of their experience. We've got folks that have got an operational background, folks that have got finance, equity market experience, and then obviously CEO and management experience on the board side. So really, again, a complementary and diverse set of skills, which has really been great for the management team to tap into. And then as I mentioned, on the management side, The one thing that will shine through strongly on the management side is we've come with strong operational background. By way of background, Christian Cortez, who's our CFO. Christian's been in the lithium industry probably close to 10 years, held CFO roles previously, understands the market, has run marketing for significant lithium players previously. Sylvain Collard, who's our Chief Operating Officer and also our President in Canada, who operates NAL, really experienced operator. Strong mining background, has worked across the gold sector, worked both in Quebec and also externally, so really a well-versed team. Sandra, who heads up the people function, again, career HR person that's been around the mining area. Monique Parker, who's up sustainability, process engineer by training, who's worked operationally in the processing side of things. Dylan Roberts has been around the mining sector and particularly lithium again as a lawyer and general counsel for a better part of a decade. And then Andrew Barber, investor relations, a geologist by training, and then also heads up our development as well. And then Melissa Gordon, who rounds out government affairs in the US and is obviously engaging strongly with the Trump administration now as we think about these aspects. But really what I wanted to leave you with is that we've got a very strong operational focused management team that has got experience in being able to take projects right the way through from exploration through greenfield development and into operation, and then being able to sustain those operations as we move forward. Just wanted to pause briefly and just give folks a bit of a sense on the market and why we think lithium is such a great investment. So if we come back to fundamentals, just on the chart on the left-hand side, you'll see this is from Benchmark Intelligence. You'll see different compounded annual growth rates, or CAGR, as it's described, ranging anywhere between 10 and 30% through to 2030. Benchmark had around 14%. I mean, if you think about, there's really no other commodity that you're seeing that sort of compounded annual growth rate. So we're absolutely in the right space. And the reality is, if we sort of double click on that and we look at around the North American market balance in particular, you'll see that there's a growing deficit that's occurring there. And globally, we expect to see that deficit also occur. So the market had been in a situation where we'd seen an oversupply situation, but the fundamentals are absolutely strong. And we're seeing that demand continue to grow. And the fact is, because we've seen a lull in pricing, we haven't seen capital flow in terms of bringing on additional capacity. So what we anticipate is that the market will snap back in pricing, and it will snap back. Certainly what we've seen historically, it snaps back quite quickly and it's quite volatile. So one of the key elements that we think about is that for that then to work in our favor is incumbency is important. And as a producer, we've got that. And so there's just two charts here I want to step you through briefly. The top chart just demonstrates the gross annual production of those spodumene concentrate producers that were in production last cycle through. And then the graph down below represents the spodumene price and then the respective profit that those respective players had made during the period. And really the headline message here is that in the lithium sector, incumbency is important, and being an incumbent producer is imperative if you want to take advantage of when prices snap back. Now, not for a moment suggesting prices will snap back to the levels we'd seen previously, but certainly prices, and I think we've seen recently, prices have continued to melt up as a consequence of the market tightening. So we expect to see a price recovery. And the key to it is that you need to be producing and you need to be established as a player. And so you can see those that performed well and were producing did very well when the price recovered. Those that weren't in production missed it. So incumbency is important, and we're uniquely positioned as North America's largest hard rock spodumene producer that when the price turns, that we're nicely leveraged to it. So we just step into NAL. So NAL is the acronym for North American Lithium. It's our operating asset in Quebec. It's located in the Abitibi region, just near Val d'Or. So it's a strong mining region with a lot of expertise. As I said, Sylvain Collard's assembled and is leading a great team there. We've been through the ramp-up period, and a couple of points to note. So if you look at where the ramp-up started back in Q1 of FY24, you'll see that mill utilisation has improved significantly, and also recovery. We're a flotation-only operation, so anything around 69% sort of industry leading. We saw really exceptional performance in Q4, which is a combination of a couple of things on the recovery side of things, and we're targeting to strive to be back towards those sort of areas, but really at an industry-leading position at the moment. The consequence of us being able to get excellent mill utilisation and that recovery up is that we've seen volume stabilise, and we saw Q4 of FY25 at just over 58,000 tonnes, and last quarter just over 52,000 tonnes. Difference being that Q4 we didn't have any significant maintenance during that period from a planned maintenance perspective, whereas we had planned shutdowns during Q1 of FY26. So despite that, you'll see unit costs have been tracking, have improved significantly from the ramp up position. They're in Aussie dollars again, and we're now seeing costs in the high 700s on a US dollar basis. So we're certainly heading in the right direction. And as I said earlier in the call, on last quarter, we were quite close to operating cash flow break even on a tonnes produced basis. So certainly things are heading in the right direction. Some more work for us to do there. So we're certainly not resting on our laurels, but again, we've got a really solid operating base at NAL to be able to continue to expand upon. And for those of you on the call that may be a little unfamiliar with the location of our assets, you'll see North American Lithium, which are located to the northwest of Montreal. So Montreal is at the bottom of that map. Importantly, we really enjoy a couple of strategic benefits, apart from the geology of NAL, which is a fantastic deposit. It's just under 100 million tonnes of resource and just under 50 million tonnes of reserve, you know, at really pretty impressive grades at 1.15%. One of the key additional benefits we've got is that we're close to infrastructure, so power, water, all those sort of key elements, and importantly, rail logistics. So currently we produce at NAL, we truck to the town of Val d'Or, and then from Val d'Or, we rail down to the port of Quebec. So the access to labour and those other key attributes is a key advantage for us. The other project that, while we've got this on the slide, I want to spend a moment on is Moblan. So Moblan's a greenfield project. Absolute beast of a deposit, just continues to surprise on the upside. Over 120 million tonnes at just under 1.2%. A terrific project. And again, enjoys the luxury of being close to power, water, and importantly, logistics infrastructure. So the town of Chibougamau, just to the south, has got a rail heading, and again, access through to ports is available via rail. So we are in a really unique position with our Quebec assets in terms of both NAL as an operating asset, its brownfield expansion capability, and then Moblan as a greenfield project. Because if we were to compare that to some of the other projects that are further north in the James Bay region, the challenge for those projects is connectivity with rail and so forth. So logistics costs are significantly higher. In addition to that, the further north you go, particularly in the Canadian winters and the Quebec winters, they can be pretty challenging around being able to construct and so forth. So really at a distinct advantage from our perspective in terms of the location of our deposits, both in terms of the quality of the geology, but also the geographical location as it relates to logistics and infrastructure and so on. Which, you know, if I was to sort of put that together and we put in the entire resource base in North America, you'll see that on a resource basis, if we include measured, indicated, and inferred, we're over 200 million tonnes of resource. And then importantly, as we think about brownfield expansions and so forth, and I'll come to that in a little more detail, we're highly competitive in terms of our capital intensity. And in fact, we'd expect that our project will continue to drift further to the right as other players update their estimates around capital intensity. So that capital intensity reflects a scoping study which we released in early September. So it's sort of very much up to date. So very large resource base, brownfield and greenfield opportunities, and are able to be developed in a capital efficient manner. So then just stepping through the portfolio, I've spoken about North American Lithium in terms of its operating potential, but one of the key aspects that we did want to spend a moment talking about is the expansion capability of NAL, and I'll come to that in a moment, but suffice to say, it's a very exciting asset. I've spoken also about Moblan, over 120 million tonnes of resource, as I said, greenfield project, still lots of potential there. We developed that resource base on the back of flow-through share funding exploration. That money was expended last year, so right now our focus is on updating the existing DFS. We hold 60% of Moblan. Our other joint venture partner is Investment Quebec. They hold another 40% of the asset. no question, it's a great greenfield development project. Based on what we've seen on historical performance through permitting and process, that's probably a minimum of 5 years to get that project through to permitting. So that's that's an important number for you to bear in mind as we think about the sequencing of the projects that we've got in the portfolio. But no question, it's a fantastic deposit and will be truly a long life, low cost hard rock spodumene concentrate producer. The initial DFS had unit cost sitting around 555 Canadian per tonne sold, so an FOB basis. So really quite an attractive, well, very attractive project, and one that will continue to push forward. Right now, it's very much around environmental permitting and getting that project progressed. Then want to spend a moment touching on Awoya, which is label number 2. We've got a JV interest with Atlantic Lithium. We've got the ability to earn up to essentially 47% of the project. We currently hold 22.5%. We like the project. Technically, it makes a lot of sense. Of our portfolio, arguably probably between that and NAL, the most shovel-ready projects we've got in the portfolio. We're working through with Atlantic. They're a great JV partner. The way that JV structure was structured when it was first designed was that, in short, for Elevra, which previously was Piedmont, to earn up to that 47%, we needed to fund the first $70 million US of the capital. Atlantic have got a capital estimate around, say, 180 million or 185 million US on Awoya. So in short, we'd fund the first 70 million, and then the balance would be funded 50-50. The reality is that on that basis, we'd be funding around 2/3 of the capital for around 50% of the asset. So those numbers probably, they're not as attractive as what we've got in the potential with NAL, the Brownfield Expansion, and also Moblan. So, this probably give you a bit of a steer about how we're thinking about the sequence and the priority. Clearly there's something to be done there with Awoya. It's a great project, but the structure right now doesn't really work for Elevra, given the great set of options that we've also got in the portfolio. And then if I just step across the Carolina project it's labeled as number 4. The Carolina project's located in the US, in North Carolina. Smaller resource base, around 44 million tonnes, as compared to, say, NAL at nearly 100 and Moblan at north of 120 million tonnes. The way that the project under the Piedmont banner was considered was as an integrated project. That is a hard rock spodumene mine co-located with a downstream lithium hydroxide facility. As I said at the top of the call, our expertise is as a hard rock spodumene concentrate miner. So one of the key attributes for us to be able to sort of move Carolina forward in a meaningful ways, we've got to have the right technical partner, and that's someone that understands lithium chemical production, and then also being able to fund that project. So a much larger capital ask, and obviously getting the technical aspect resolved is important. What we've seen to date is that those investments in downstream chemical conversion outside of China have been somewhat challenging. We've got, I think there's a significant amount of examples in Western Australia where it's probably not gone according to plan, both technically and commercially. We're very mindful of that. So that's an area that, we're going to evaluate carefully. But as I said, our expertise is upstream. So we would need a technical partner that can bring the balance sheet strength and also the operating expertise to be able to develop that project. So strategically, very well located. It's an important part of the Elevra portfolio, but a couple more attributes that we're going to need to be able to move that project forward. So I did just want to spend a moment on the Brownfield Expansion, which is our nearest term priority for us. One of the things that has occurred since we've had NAL is that, and acquired NAL, is that we've grown the resource base appreciably. And the consequence of that resource base now having grown to the extent that it has is that NAL will support a much larger production profile than it has historically. So we're producing around 200,000 tonnes a year. We've released a scoping study that would take production to 315,000 tonnes of concentrate per year. Now, why this is so important and why we're so excited about is what it does for our unit costs. So it would see us drop our unit costs on a US dollar basis below $600 a tonne on cash cost, which really puts us in a very unique position in that effectively you'd be able to get through typically any price cycle that we've seen in the last, say, 5 years. So really an important project that we're pursuing, and importantly, it's also a capital efficient project because it's a brownfield project. So what the project really contemplates is revising the crushing front end and then adding additional milling and flotation. So technical risk perspective, very low risk. It's building upon an existing asset. We've got the infrastructure, we've got the logistics chain, and we've got an experienced team that knows how to operate a hard rock spodumene mine. So really a great deal to like about the project. Capital costs around 270 million US is our estimate. And so we're busily working through the approval stage. So if we think about timing, to date, the nature of this project and given the footprint of the mine needs to expand, the timing would probably be around 2.5 years to get through the approvals process. We're engaging with the authorities about whether it might be able to be refined. But ultimately, what we want to be able to tell the market is that, based on historical performance with permitting authorities and processes, it'll be around 2.5 years, followed by another 18 months of construction. If we can reduce that or find a way of being able to refine that approvals process to bring it online sooner, we certainly will. But nominally, you'd see the expansion under the current plan, that additional volume coming to market at the back end of the calendar year 29. But as I said, this is our immediate focus, and it's very much around the approvals process, our critical path. So that's an area that's of immediate focus for Sylvain and the team and the rest of the management team. And I'll just jump ahead and then come back to a couple of aspects. One of the key questions for investors is, well, that's great, 270 million. We like the project. It makes a lot of sense, but how are you thinking about funding it? I think importantly, given that we're an established producer now, we're thinking about ways in which we can bring in strategic investors, and bring them in at, for example, at the asset level. By way of example, the NPV for North American Lithium, NAL, under the Brownfield Expansion is just under $1 billion US. So if we were to bring in a strategic investor at, say, 20%, there'd be 200 million of the 270 million there that we could fund immediately. So there's a number of ways that we're thinking about that. So strategic investors, being able to bring people in, traditional debt structuring, obviously is a possibility, given that we don't have any secure debt on the balance sheet. We've got that flexibility. Importantly, also tapping into both US and Canadian governments in terms of where those opportunities might exist, including there's a number of funds that have been set up strategically by the Canadian government around making those sort of investments as well. So there's a range of options there that may actually prove not to be non-dilutive. So rather than having to raise at headco, but also we've got the flexibility. So I think in short, we've got a very attractive expansion opportunity at NAL with a number of levers that we can pull that should have investors quite excited about how we can bring that project to life and also do it in a way that's very efficient for investors. We put this slide together at the commencement of the merger. So you'll see there's still quite a bit of work to do, particularly around Ewoyaa and Carolina. And some of those activities, they're in flight, but they've not yet progressed. So we did really want to give people a sense that we've been cracking on with it, given that we've closed the merger, over probably a couple of months now. So good progress being made, more to do, but we certainly want to give investors the clear confidence that we're focused on delivering upon what we said we're going to do. And it's very much a case, as I said at the top of the call, of driving through those three strategic elements over the next 18 months. And then just to close out, we published this previously around guidance. I think I've probably touched on the bulk of these numbers as we've been through it already, other than probably capital expenditure. Pretty modest. The bulk of that capital is for NAL, around 30 million, and a large part of that is around the tailings dam lift that we've had to do just to be able to meet production requirements. So we're in pretty good shape. As I said, about $150 million of cash at the end of Q1. So well capitalized and uniquely positioned to take advantage of a recovery in prices, and with a really attractive, and we'd suggest probably an unparalleled set of growth options in jurisdictions that are attractive and are very topical at the moment. So, Luke, with that, I'll pass back over to you, and very happy to take any questions people might have.
Yeah, absolutely. No, that was a very in detailed presentation. I think you've pretty well covered a lot of my questions anyway, and I might just answer or ask you a couple of questions as more of like a recap, just to leave people with something before they leave. But My main question was obviously around, so what was the strategic rationale for the merger between Sayona and Piedmont, and how will that create value for shareholders?
Yeah, look, I think at the very core of it, there's a synergy piece. So 15 to $20 million for companies our size of annual recurring savings, nothing to be sneezed at. So they're there, but really the real kicker has been the removal of the offtake obligations that existed with Piedmont and Sayona. And in short, the way it was structured was Piedmont were picking up sort of north of 65% of the offtake, despite only holding sort of 20% of the assets. So in short, we were never going to fund the bulk of the capital for NAL expansion to only see 50% of the offtake. So in short, it's removed that impediment and it's enabled us to be able to grow NAL. And there's going to be a tremendous amount of value uplift for investors and shareholders as a consequence of being able to bring NAL in, because of those reasons that I described. We've been able to reduce our cost base and really be able to ensure that the asset is robust through every price cycle.
Yeah, awesome. Now, you touched on the lithium market. I understand that the big thing for you guys is you go debt free, and that's awesome, right? But given the volatility in the lithium market, what steps has Elevra taken aside from the being debt free, operationally and commercially, to build resilience and position the company for long-term success?
Yeah, thanks, Luke. I think a couple of things. We have engaged in take some forward pricing, and that's been very much around really probably more so providing downside protection. So we wanted to make sure that we maintain leverage to a price recovery. So it's been taking a balanced approach, and I think shareholders should be able to see that if they look at our comparables in terms of realised pricing for materials sold compared to others, where we've typically, I think, the last 2 quarters outperformed other hard rock spodumene producers. So that strategy is playing out. Clearly, we'll continue to refine that, but again, we wanted to make sure that we're still maintaining exposure to that price recovery because, particularly given the position we occupy on the cost curve, we are uniquely positioned and leveraged to that price recovery.
Yep, awesome. Now, I just had a question from one of the attendees, Ollie. You touched on your 18-month plan. Ollie's asked, will management be releasing a clear 2 to 5 year strategic plan with defined milestones, timelines, and financial targets?
Yeah, so I think people certainly can expect to see a refinement of the strategy for Elevra. We've only just constituted the board. We're working through a couple of those key strategic decisions for us now in terms of that project prioritisation. I think people should get a clear steer that NAL is our immediate focus, both in terms of our operation and also the project development sequence. So I think people should feel confident on that. I appreciate all this question, and people will expect to see more granularity, particularly towards the into the new year as we refine that strategy. So there's a few elements that we've got to work through, and there's a few moving pieces. As I said, things like a Warrior and the deal with Atlantic probably doesn't work for us right now. So there's some stuff there that we need to work through.
Yeah. Now, just on Atlantic, there's another question there. Will you be maintaining investment in Atlantic Lithium or?
Yeah, so in short, I think one of the questions was, what are we contributing at the moment? So our equity stake at present is 22.5%. As I said, we've got the ability to earn up. We're contributing on that equity basis. That's how we consider the appropriate and in line with the JV agreement. So we'll continue to fund in line with equity, which is the normal your equity position, which is the normal way that these things are structured. So as I said, we like the project. The way that the JV deal is structured is probably it makes that project probably less attractive in our portfolio, given that we've got a number of great other options. But we very much like that project, and it's got a place, but we've got to get the right investment conditions around it.
Yeah, absolutely, mate. That's all the questions I had for you. Honestly, you answered all of them during your presentation anyway. But yeah, the presentation was very in detail, and I think it gives investors a lot of confidence moving forward, which is awesome. And I wouldn't be surprised to see you back here doing another webinar in the next 5-6 months with some good news ahead. So I appreciate everyone coming along. I think Lucas, I appreciate yourself as well and your time. But I'll see you in the next one, huh?
Thanks, Luke. And thanks, Ron. Sorry, Luke, there was one question I'll just quickly touch on it from, I think Ollie had it just around why we're going to 315,000 tonnes rather than 400.
Oh, yeah.
We've done some initial work around it. 315 is probably somewhat a bit of a sweet spot in that space in terms of the unit cost position. So, we'll continue to, whether that's, ends up at 350 or 330, there's probably a little bit more optimization to do. And then the second part was, why does it take so long? Yeah, that's a great question. As I mentioned, the critical part for us is the permitting. So anything we can do with the authorities to be able to reduce that, you can rest assured that we're exploring all those opportunities. If we can truncate that, the construction period is actually pretty quick. So it's very much about getting the permitting and the critical path on that resolved. So that's what we're focused on. But I appreciate the questions, and thanks again, Luke.
No worries. Thank you, everyone.